Hello everyone, welcome to this group presentation video with the material of statement of financial position and statement of cash flow. Before that, let me introduce myself. I am Eka Xavier Valencia with my partner Shafa, Assyifa, Evelyn, and Mezaluna. Enjoy the video.
Financial position. So this statement of financial position is providing information on asset, liabilities, and equity, which is provide a basis of computing rates of return and evaluating the capital structure of the enterprise. There is a liquidity, which is the amount of the time that is expected to elapse until an access is realized or otherwise converted into cash or until a liability has to be paid. There is also solvency, which is the ability of a company to pay its debts as they mature. So this liquidity and solvency affect company financial flexibility, which is ability to take effective action to alter amounts and timing of cash flow. There is also limitation of the statement of financial position, which is one, most asset and liability are reported as historical costs. So it's being reported when it was back then, buying and back then. And then the second one, it's company asset. A company use judgment and estimate to determine many of the items reported as the statement of financial position. The third one is the statement of financial position necessary admits many items that are of financial value, but the company cannot record objectively. Statement of financial position, which is asset and liability with different general liquidity characteristics. The second, asset that differ in the expected function in the company's central operation or other activities. And the third one is liability that differ in their amounts, return, and timing. And then elements of the statement of financial position, there is asset, liability, and equity. First, in asset there is non-current asset. There is one long-term investment. This is a investment that normally consists of one of these four types, which is one, invested in security such as bonds, ordinary shares, or long-term notes. Second, investment in tangible asset not currently used in operation, such as land, that held for speculation, and the third, investment set aside in a special fund such as sinking fund, pension fund, or planned expansion fund. And then the fourth one is investment in non-consolidated subsidiaries or associated company. Companies group investment in debt and equity security into three separate portfolios for valuing and reporting purposes, which is the one is held for collection, two trading, and the third is non-trading equity. The held for collection is a debt security that a company manages to collect contractual principal and interest payment, and then trading is a debt and equity security booked and held primarily for sale in the near term of generate income on short-time price changes. And then the last one is non-trading equity, which is a certain equity security held for purposes other than trading. Property, plant, equipment. This is a tangible asset, which is long-lived asset used in regular operation of the business. This asset consists of physical property such as land, building, machinery, furniture, tools, and wasting resources like minerals. With the exception of land, a company either depreciates like building depreciation or despises like oil reserve this asset. There is also intangible asset, which is like physical that aren't financial instrument, just like a patent, copyright, franchise, trade name, and customer list. And it could be being amortized or the price of that intangible asset it could reduce. There is also other assets. It could be items like a long-term prepaid expense and non-current receivable, or even other items that might be included are assets in special funds like property held for sale and restricted GOGS or securities.
So, still in the talk of classification in the statement of financial position, I'm going to talk about the current asset. Current assets are cash and other assets a company expects into cash, shall, or consume either in 1 year or in the operating cycle, whichever is longer. The 5 major items found in the current asset section is first inventory, prepaid expense, receivable, short-term investment, cash and cash equivalent. First, inventory. Inventory is to present inventory properly, a company discloses the basis of valuation, like a lower of cost or net realizable value, and the cost of low assumption used like a FIFO or average. Second, prepaid change. A company includes prepaid expense in current asset if it will receive benefits within 1 year or of the operating cycle, whichever is longer. As we discussed earlier, these items are current assets because if they had not already been paid, they would require the use of cash during the next year operating cycle. A company reports prepaid expense at the amount of the unexpired or unconsumed cost. Third, receivable. A company should clearly identify any anticipated loss or due to uncollectible account, the amount and nature of any non-trade receivable, and any receivable used as a collateral. Major category of receivables should be shown in the statement of financial position or the related notes. For receivable arising from unusual transactions such as sale of property or a loan to associates or employee, company should separately classify this as a long term unless collection is expected within 1 year. And the fourth is short-term investment. A company should report trading security, whether debt or equity, as current assets. It classifies individuals' non-trading investment as current or non-current. Depending on the circumstances, it should report held for collection securities at amortized cost. All trading securities are reported at fair value. And the last is cash and cash equivalent. Cash is generally considered to consist of currency and demand deposit. Cash equivalents are short-term, highly liquid investments that will mature within 3 months or less. So we still talk about classification in the statement of financial position, but now we're going to talk about the equity section. So the equity section is one of the most difficult sections to prepare and understand. This is due to the complexity of ordinary and preference share agreements and the various restrictions on equity imposed by company laws, liability agreement, and boards of directors. Company usually divides the sections into 6 parts. First, share capital, the par or stated value of share issue. It includes ordinary shares and preference shares. Second, share premium, the excess of amount paid in over the par of state value. Third is retained earning, the company undistributed earning. Fourth is accumulated other comprehensive income, the aggregate amount of the other comprehensive income item. 5 is treasury share, generally the amount of ordinary shares repurchases. 6, non-controlling interest, a portion of the equity subsidiaries not owned by the reporting company. Lastly, in the classification in the statement of financial station, there is a liability, but there is 2 types of liability. There is a non-current liabilities and current liabilities. First, we're going to talk about non-current liabilities. Non-current liabilities are obligations that a company does not reasonably expect to liquidate within the longer of 1 year or the normal operating cycle. Instead, it expects to pay them at some date beyond that time. The most common examples are bonds payable, notes payable, deferred income tax, lease obligation, and pension obligation. Companies classify non-current liabilities that mature within the current operating cycle or 1 year as current liabilities if payment of the obligation requires the use of current asset. Generally, non-current liability are of three types. First, obligation arising from specific financing situation, such as the issuance of bonds, long-term lease obligation, and long-term notes payable. Second, lease obligation arising from the ordinary operation of the company, such as pension obligation and deferred income tax liability, obligation that depends on the occurrences or non-occurrences of one or more future expense to confirm the amounts payable or the payee or the debt payable, such as service or product warranties, environmental liabilities, and restructuring, often referred to as provision. And then the next is current liability. Current liability are the obligation that company generally expect to settle in its normal operating cycle or 1 year, whichever is longer. This concept includes first payable, resulting from the acquisition of goods and service, account payable, salaries, and wage payable, income tax payable, and etc. Second is collection received in advance for the delivery of goods or performance of service, such as unearned rent revenue or unearned subscription revenue. Third is other liability whose liquidation will take place within the operating cycle or 1 year, such as the portion of long-term bonds to be paid in the current period, short-term obligation arising from purchase of equipment, or estimated liability, such as warranty liability. As indicated earlier, estimated liability are often referred to as provisions.
We're talking about retained earnings. What is retained earnings? Retained earning is profit kept by the company and not paid as dividends. And there's some change in retained earning. When it comes to net income, it's gonna be increased, and when it comes to net loss, cash dividends, or share dividends, it's gonna be decreased. And the formula of retained earning is beginning retained earnings plus net income minus dividends equal ending of retained earnings. And there's a restriction about retained earnings that it cannot be used freely due to company policy or contract. So now we're talking about comprehensive income. What is comprehensive income? There's a total company performance that includes income statement and OG, other comprehensive income. And what is OG? OG is gains or losses not included in net income. The example is unrealized gain from investment. And comprehensive income has two reporting methods. The first one is one statement or combined report, and second one is two statement or separate reports. And now we're gonna talk about change in equity. Statement of change in equity shows how company equity change over time, includes the share capital, the retained earnings, dividends, and OG. And accumulated OG shows total OG collected over time and shown in equity section of balance sheet. And why is it important? Because it shows company's performance, so profit distribution, and help investor understand financial position.
So the primary purpose of the statement of cash flows is to provide relevant information about the cash receipts and cash payments of an enterprise during a period. To achieve this purpose, the statement of cash flows report the following. One is the cash effects of operating during a period. The second one is the investing transaction. The third one is financing transaction. And the fourth one is the net increase or decrease in cash during a period. The next one is the content of statement cash flows is first, operating activities that involve the cash effects of transactions that enter into the determinations of net income. The second one is the investing activities that include making and collecting loans and acquiring and disposing of investments, both of the debt and equity, and property, plant, and also the equipment. The third one is the financing activities that involve liability and equity items. They include obtaining resources from owners and providing them with a return on their investment. And the next one is borrowing money from creditors and repaying amounts that borrow. Companies obtain the information to prepare the statement of cash flow from several sources. The first one is comparative statement of financial position. Second one is the current income statement, and the last one is the selected transaction data. Preparing the statement of cash flows from these sources involves the four steps. The first one is determine the net cash provided by or used by the operating activities. The second one is determine the net cash which provided or used by the investing and financing activities. The third one, determine the change, increase or decrease in cash during the period. And the fourth one is the reconcile the change in cash with the beginning and the ending cash balance. Not all of a company is significant activities involve cash. Example of significant non-cash activities are first one issuance of ordinary shares to purchase asset. The second one conversion of bonds into ordinary shares. The third one, issuance of debt to purchase asset. And the last one is exchange of long-lived asset. And in the next slide, we're gonna talk about the usefulness of the statement of cash flows. Although net income provides a long-term measures of a company's success or failure, cash is its lifeblood. Because without cash, a company will not survive. For small and newly developing companies, cash flow is the single most important element for survival. Even the medium and the large companies is also must control the cash flows. A high amount indicates that a company is able to generate sufficient cash from operation to pay its bills without further borrowing. Conversely, a low or negative amount of net cash provided by operating activities indicates that a company may have to borrow or issue equity securities to acquire sufficient cash to pay its bills. So the companies sometimes report a high net income numbers, but the negative net cash provided by operating activities. This type of situations can eventually lead to the bankruptcy. And to find the financial liquidity, the formula is net cash provided by operating activities divided by average current liabilities that will equals current cash debt coverage. And to find the financial flexibility, the formula is net cash provided by operating activities divided by average total liabilities that will equals cash debt coverage. And the last one, to find the free cash flow, the formula is net cash provided by operating activities and then minus by capital expenditures minus by cash dividends that will equals a free cash flow.
Okay, for the final part, I will explain the additional information provided in financial statement. First is note to the financial statement. This note provide essential detail that number alone cannot show, such as explaining which specific asset are used. Second are technique of disclosure. There are two main types. First is contra account. This reduce an account balance. For example, accumulated depreciation show how much an asset value has decreased over time. And then adjust account. This increase a balance, for example, a fair value adjustment added to an investment account. And finally, the rule of offsetting. Under EIS 1, asset and liability must be reported separately. We cannot simply deduct a debt directly from our cash balance. Offsetting is improper because it hides the real transaction and makes the statement less transparent. Thank you for watching our group presentation video, and bye bye.